this is something we call campaign trading, right? But we're essentially, a hint is that we're kind of diversifying across a couple of different things. What do you think that might be? Dan says diversify. Yep, diversify against what? Ken says changing markets. All right, specifically what type of change are you referring to, Ken? You're right, though. Rich says time. Dan says movements. Ken says news. That's interesting. Ken says CPI. We've got strikes at correction, skew. All right. Yep. So a whole bunch of stuff being put out there, and they're pretty much in line with reality. So the option trading, unlike traditional, stock or ETF trading, which is most people call that, like Delta One trading, you're making money purely from Delta, So if you buy more shares and it goes in your direction, you make more money. But similarly, if it goes against you, you lose more money. And that's it. That's all you got to worry about, just price. Option trading is kind of like the onion concept, that it's multiple different layers. And actually, the more you learn, the more you realize there are even more layers than you expect. Once you start learning about second order Greeks and skew and all this kind of stuff. So, but the reality is, you're all quite right in terms of the various things that were talked about here. So you want to diversify with volatility, because nobody knows the future. And people say, volatility is mean reverting. Fine. That doesn't imply that it's not going to go up instead of down tomorrow. If it's so-called high, what does high mean? Who knows? Volatility can get beyond 100 with the VIX. But it's rare, of course. And if we're at, let's say, 20, then does that mean that it's going to go back to 10? No. It could go either way. You just don't know. So by diversifying through time, through here, we're diversifying that particular factor of implied volatility. And we're just essentially like dollar cost averaging, as you hear about with people doing that, in terms of price, we are implied volatility cost averaging kind of thing, and spreading our risk, because again, we don't know what volatility is going to do. Similarly, there are other variables that are going to be affected in that way. So for example, skew is another great example. Skew is going to go up and down and absolutely will impact your profit and loss. And you just don't know what tomorrow is going to be. So you might want to diversify skew out as well, which you can do with this type of thing. Another thing, though, that is quite relevant is just thinking of price action itself. So if SPX is here, let's just kind of go up and down instead of left and right like we normally do on a risk graph. But if SPX is at this particular level, and you know what, let me do the traditional view, which is like left to right. So this is currently where at the money is. And if you were to put on a trade, let's say here, and do your 6-lot trade, okay, all in one hit, this is your distance. And the reality is that, a traditional broken wing fly, you might make money in terms of the theta range, from, say here to here, something like that. This is where the juicy theta lives in terms of making money from so-called time. But what happens if the market moves in this particular direction and goes up? Now, if the market's here, your trade is a very far distance away from where the market is. And the likelihood of you making money in this zone over here is very, very low. Okay. So by not doing this and us simply doing 1 lot over here, and now if the market does move higher up through to this particular level, now when we put in our second tranche is now going to be here. So we've got 1 lot here, we've got 1 lot here. Now the market keeps going higher, the market's here, our third tranche is going to be here. Market pulls back, our fourth tranche might be around here. Pulls back again, it might be somewhere else. So what you're now getting is you're getting a much, much wider span of where your trades are going to be able to potentially make money from in a realistic way, as opposed to putting all your eggs in one basket and hold and pray that the market doesn't get too far away from you. Okay, so this is a way of kind of like stretching out our profit zones significantly by spreading out and doing campaign trading. All right, so there's quite a lot of benefit there of not just diversifying, but also expanding that profit zone that is what you really want. So this is the concept of what we call campaign trading.